In Chapter 14, we begin to dig a little deeper into what exactly is managerial accounting. Managerial accounting is simply an accounting system that's intended to provide information for the managers of the organization. In Accounting 101, you learned financial accounting, and financial accounting is geared towards creating your financial statements, and those financial statements are used both internally and externally. Managerial accounting, which we're concentrating on now, has more of an internal focus, and we're providing information that is both financial and non-financial in order to help managers carry out their job. So they're looking at budgeting processes. They're looking at how efficiently and how effectively is the company running. And in the end, they're looking towards those financial statements, but managerial accounting is intended to help enable managers to make decisions. So here we have a slide that just goes over and it compares and contrasts the difference between financial and managerial accounting. I'm not going to touch on all of these, but I'll touch on the most important. We've already mentioned that financial accounting is more externally based, whereas managerial accounting is internally based. Financial accounting, when you learned financial accounting, all of those rules and everything that you were learning was controlled by generally accepted accounting principles, which are written by the FASB, and this is all government regulated. Managerial accounting, although there are types of ethical standards and things that managerial accountants need to follow, there are no gap constraints. This is not regulated by the government because external users or people external to the company are not using managerial accounting. Instead, the managers and people internal to the company are the people deciding what they want out of their managerial accountants. Another thing that's important is the time dimension. Financial accounting, we're reporting what has already happened. Managerial accounting, on the other hand, we do look towards the past, but we're also projecting towards the future. Finally, when we look at financial accounting, we're only looking at dollars or monetary information. Managerial accounting, monetary information is very important, but we're also looking at efficiency type measures or for example, managerial accounting, they might be looking at if you have a manufacturing plant, how is a specific line running? So in that case, rather than looking at money measures, they might be looking at time. Another thing that managerial accounting might be looking at is the quality of how things are being made. So what kind of numbers of defects and things like that. So managerial accounting is a more full picture of the company. It's not simply financial. We're now going to begin to define some cost classifications. And these are just terms and things that you'll need to understand as we move forward. So the first two cost classifications that we're going to look at are total fixed costs versus total variable costs. And it's important here that we're noting that we're talking about these costs in total, not on a per unit or per product basis, and we'll talk about that later. So when we talk about cost classifications, we're looking at how does a cost behave. And what we talk about when we say behavior, we're referring to how does the different levels of activity within a business affect specific costs. So if we're talking about fixed costs, these costs stay the same, and they're not going to change simply because we make more or less of our products. On the other hand, variable costs, these costs in total are going to vary in proportion to changes with activity. So you can see here we've got graphs that depict total costs. These here are our total fixed costs and our total variable costs. What you can see here, this is the y-axis, this vertical axis here, and that represents cost. So these are what we're talking about in dollars. It's the same on both graphs. And then here on our x-axis, this is activity. If you remember much about graphing, you'll remember that the y-axis is what we call our dependent variable, and the x-axis is the independent variable. And when we're talking about dependent versus independent variables, the dependent variable typically depends on what happens with our independent variable. So let's look here. By nature, fixed costs stay the same. They are not dependent on our activity level. So you can see here that if we are at a level of activity of 0 right here at the origin, or let's just put some numbers here, let's just assume would be a level of activity of 50. And when I say 0 versus 50, when I'm talking about activity, I'm talking about activity of products being manufactured. So whether we manufacture 0 or 50 products, our total fixed costs stay the same. An example of a fixed cost might be the rent on your manufacturing building. It does not matter if we are actually producing something or not. Once we sign that rent contract, that cost is set. It doesn't matter if we are making anything or if that building is simply sitting empty. We have a liability to pay this, and therefore this cost is going to be there. Variable costs, on the other hand, you'll see here that our dependent variable, the costs, they do vary as we change our levels of activity. So you can see here if we have a level of activity of 0, our cost is 0. But then if we move up into more levels of activity or we're making more products, our cost also increases. A typical example of a variable cost would be, for example, our direct materials. So let's say we are making bicycles, and the cost that we're looking at right now is the cost of our tires that we put on the bike. Let's say tires cost $10 per bike. We're just throwing some numbers out there. If we make 0 bikes, then we have a cost of 0 because 0 bikes multiplied by $10 is 0. However, let's move out here and let's just say that we make 50 bikes. If we make 50 bikes, 50 multiplied by 10 tells us that we have a cost of 500. So you can see in total the amount of our variable costs depends on how many items that we're making. So that's the difference between fixed costs and variable costs in total. Now we're going to look at what we call direct costs versus indirect costs. Direct costs are our easier types of costs, and these are costs that we can easily trace to a specific object. The example that I gave on the previous, when I was talking about direct materials, those tires can only go to one product. So we can easily trace that these 2 tires went to this one product. We can't split tires between 2 different bikes because half a tire would do no good. So we can easily trace a specific tire to a specific product, and then we can apply the cost of that tire to that specific bike. Another example of a direct cost would be the labor. So if you think that you have someone who is actually going and they are putting those tires onto the bike, that person, the amount of time and the cost of their labor can easily be applied to that one specific bike. So our direct materials and our direct labor are the best examples of direct costs. Indirect costs are items that cannot easily be traced to a single item. So let's go back and we'll think about the example that I gave for a fixed cost. I mentioned rent on our building, rent on our manufacturing building, in fact. That rent is important because if we do not pay rent, we won't have a manufacturing facility, and therefore we will not be able to make any bikes. So can you see that the rent, the expense that we pay for the rent on that building, is relevant to the bikes that we make? However, we can't apply all of that rent to one specific bike. Instead, the rent on our building is really applicable, and it is part of the cost of all of our bikes, but it's not specific to one bike in particular. So that is why rent is an example of an indirect cost. It is a cost that affects all of our items, and it can't specifically be traced. Another example might be manufacturing expenditures that benefit 2 or more departments, maintenance expenditures. So if you think about if you have maintenance workers in the building, maintenance workers, they go around and they work on the different machinery. So therefore, their work helps the machines, and those machines help make many different products. So we have to find a way to help apply a small portion of that maintenance expenditure to all of our different products. And we'll look at how we do that as we move forward. But that's called allocating our indirect costs. Now we're going to look at the difference between product costs and period costs. This is a very important difference because it's going to affect how these different costs show up on our different financial statements. So first we're going to talk about product costs. And these are the three costs that go into making our products. Our product costs are made up of our direct labor, our direct material, and our manufacturing overhead. It's important here that we note this is manufacturing overhead. It's not simply overhead, it's only the overhead related to the manufacturing facility. Now let's also define what overhead is. 2 slides back we talked about our direct costs and our indirect costs. You can see here direct labor, that's a direct cost. Direct material is a direct cost. And manufacturing overhead, these costs or overhead costs are going to be all of your indirect costs, or those items that are not easily traceable to a specific process. Then we need to make sure we're only looking at the manufacturing indirect costs. So we can have indirect costs that apply to things like our selling or our salespeople or our accountants. Those costs are technically overhead costs, but they are not related to the manufacturing process. So those are not part of our product costs. The only indirect costs that are part of our product costs are those which have to do with the actual manufacturing process. So we're talking about depreciation on our manufacturing machinery, depreciation or rent on our manufacturing facility or the building, maintenance on the manufacturing facility, or the salary of any supervisors who supervise the maintenance facility. So again, we've got to make sure, and I can't emphasize this enough, we're only looking at the manufacturing overhead or those indirect costs that have to do with the manufacturing facility. So those 3 items, direct labor, direct material, and manufacturing overhead, are our product costs. Period costs, on the other hand, are expenses that are not related to manufacturing our product. So the examples that we're given here are selling costs that are incurred in order to obtain orders and deliver things to customers. So this is customer sales and customer support. That's not actually creating our product. It's selling our product, but it's not creating it. So we call this a period cost. Another example is administrative costs. So that's when we are talking about the people who work in accounts payable, or the people who work in accounting, or the CEO or CFO or advertising departments of the company. They are very important, but they are not actually related to the manufacturing process, so we call these period costs. It's very important that you're able to identify if something is a product cost or a period cost, because that affects how these different costs are treated on our balance sheet or on our income statement. Here we have a depiction of how these costs are treated. Period costs, these are the typical costs that you would have learned about in accounting, 101. Period costs are costs that we expense in the same year that they are incurred. So we're assuming that we're operating in the year 2015. So if we have some type of advertising expense, we go ahead and recognize that as an expense on our income statement in the current year, and that's where we would debit advertising expense and then credit the cash payment, or if we had an account payable, we would credit that to show the liability. So these are just costs that we immediately expense. On the other hand, product costs go through a 2-step process. First, those are going to be on our books as inventory. If you'll remember from Accounting 101, inventory is an asset on our balance sheet. So these costs, or the costs of building our manufacturing products, those are going to sit on our books as inventory until they are sold. And then once they are sold, they become an expense, and we call that expense cost of goods sold. You learned about cost of goods sold in Accounting 101, but what we're looking at in managerial accounting or Accounting 102, we're really getting an understanding of this timing difference that happens, and we're really going to dive a little bit deeper into understanding some different categories of inventory. So you can see here, our product costs are inventory. So if you'll remember, product costs are our direct materials, our direct labor, and our manufacturing overhead. So when these costs are incurred, we do not simply expense them. Instead, they increase the value of our inventory because the value of someone's labor of putting tires onto a bike, that increases the value of our bike inventory. So rather than expensing that as a typical salary expense, we are going to be debiting that or increasing the value of our inventory. The same way with the tires on the bike. When we use those tires, that is not an expense. Instead, the value of that tire increases the value of our bike inventory. Then, those sit on the books as inventory until they're sold. So, again, we're looking at the year 2015. Any of the inventory that we sell in 2015 then leaves our balance sheet and it becomes an expense on the income statement, and we refer to that expense of cost of goods sold. However, if there is inventory that we still hold at the end of the year, we do not expense that. Instead, it stays on our balance sheet as an asset. And then in the following year or the year after that, when we do sell that inventory, that is when it becomes cost of goods sold or an expense. So now that you understand that process, you can understand the difference between why we call this a period cost and a product cost. A period cost, by rule, is immediately expensed in the same period or the same year in which it's incurred. So every period cost that we incur in 2015 is immediately expensed in 2015. Product costs, on the other hand, they remain products or inventory on our balance sheet until they are sold. That could be during the same year, or it could be during the following year. We're continuing to look at the different product costs, and what you can see here is just a graph or a pie chart that shows us the relative percentages that our product costs make up of the total product cost. You can see here direct materials are 45%, factory overhead 40%, and direct labor is 15%. I do want to note that as the world has become more automated, and what we mean by automated, as technology becomes better and we're using more machines to do work, we're seeing a large increase in factory overhead as opposed to direct labor. If we went back before technology has gotten as good as it has, you would have seen a much larger percentage of direct labor, and factory overhead would have been much smaller, if at all existent. Because factory overhead is growing, we're having to be much more careful with how we allocate factory overhead. Because as the percentage of product costs related to factory overhead increases, we're having to make sure that we get those calculations correct, because we're talking about a much larger dollar value than we would have been when direct labor and things were more labor intensive versus machine intensive. We've already talked about the different definitions of direct material, direct labor, and our factory overhead, so those are just a couple reminders. And now we're going to give one more definition that relates to our product costs. You can see here direct material and direct labor. These are called our prime costs. Then we have the combination of our direct labor and our manufacturing overhead, and we call these conversion costs. And I want to talk about this term conversion cost. If you convert something, it means you're changing it. And so these conversion costs, these are the costs that we incur in order to convert or to change our direct materials or just those simple raw materials into our end product.